You know how many private jets are sitting on runways around the world right now? For reference, Brazil has around 760, Mexico has close to 1,000, Canada has about 530, Germany has roughly 490. The UK and France combined add a few hundred more. Add up almost every other country on the planet, all 190 plus of them, and you land somewhere around 9,600 private jets total. The United States has more than 14,600, roughly 62% of every private jet that exists. One country, more private jets than the rest of the entire world combined. And a huge part of it traces back to the tax code. Private business flying existed long before this became possible. Companies used small aircraft to move executives between factories and sales offices going back to the 1950s and 60s. But owning a jet stayed a rare, expensive decision, mostly reserved for the largest corporations, right up until Washington decided to change how equipment gets taxed. In 1981, Congress passed the Economic Recovery Tax Act, which created something called MACRS, an accelerated depreciation system, letting businesses write off equipment costs faster than the equipment actually wore out. Aircraft qualified alongside factory machinery and computers. For the first time, buying a jet wasn't just a transportation decision, it was a tax strategy, and corporate flight departments started showing up on balance sheets as depreciating assets instead of pure expense. The next push came from somewhere unexpected. After the September 11th attacks, with the economy shaken and air travel in crisis, Congress leaned on bonus depreciation as economic stimulus, encouraging companies to keep investing in equipment instead of freezing spending. Aircraft buyers were included from the start. The same mechanism got dusted off again in 2008 during the financial crisis. Twice, in moments of national economic anxiety, the government's answer involved making it easier to write off a business jet. Then came the real turning point. In December 2017, Congress passed the Tax Cuts and Jobs Act, and buried inside it was a provision letting businesses deduct 100% of an aircraft's purchase price in the very first year it was placed in service. Not over several years, all of it, immediately, for new and used aircraft alike. Bloomberg later reported the change helped trigger a genuine boom in jet sales. A company could buy a $10 million aircraft and erase $10 million of taxable income in year one. The jet stopped being a luxury item and became a line item. Now, 14,600 jets sounds like it's all billionaires and rock stars. But here's what reframes it. Roughly 37% of the US fleet is heavy or long range, built for intercontinental executive travel. The rest splits across light, midsize, and very light categories. The kind of aircraft a regional manufacturing company or an oil and gas outfit keeps to move people between plants. And fractional ownership, where multiple companies each buy a slice of a jet instead of the whole thing, has grown more than 65% since 2019. NetJets alone, the largest operator in the world, now runs over 800 aircraft and logged more than 575,000 flight hours in a single year. A huge share of these aircraft aren't personal toys. They're shared corporate assets, split 5 or 6 ways to make the write-off even more efficient. So what's keeping the incentive alive today? In July 2025, Congress passed the One Big Beautiful Bill Act, and inside it, the 100% deduction stopped being temporary. It became permanent. No scheduled phase-out at all. The Joint Committee on Taxation estimated that decision alone will cost the federal government roughly $362 billion over 10 years. It didn't go unnoticed. A group of senators publicly demanded data from the IRS on how many aircraft purchases were claiming the deduction and whether personal flights were quietly being logged as business travel. The provision survived anyway. Once a tax break gets built into how an entire industry prices its product, unwinding it becomes its own political fight. And 2025 turned out to be a record year regardless, with global business jet departures hitting an all-time high of nearly 3.9 million flights. Compare that to Europe. The whole continent has around 2,760 business jets, about 13% of the global fleet, roughly a fifth of what the US has alone. Part of that is geography. European capitals sit close enough together that a company doesn't need its own aircraft to move executives quickly. Part of it is tax policy. Most European countries never built anything close to America's bonus depreciation rules into their own equipment codes. The incentive that reshaped American corporate travel simply doesn't exist at the same strength anywhere else, which is a big part of why Germany, the largest fleet in Europe, still only has about 490 jets to America's 14,600. Asia tells a similar story from the opposite direction. China, the largest fleet on the continent, has fewer than 300 business jets, and India has under 150. Part of that comes down to stricter airspace controls. Since much of Chinese airspace remains under military jurisdiction and general aviation clearance is far harder to obtain than in the US. There's no equivalent bonus depreciation regime pulling companies toward ownership either. The tax incentive and the open skies both matter, and neither exists at anything close to American scale anywhere else in the world. The write-off isn't always used the way it was intended, and that's part of what keeps the subject politically uncomfortable. The Wall Street Journal reported that disclosed personal use of corporate jets by public company CEOs added up to roughly $65 million in a single year. All of it technically allowed under IRS rules that value a seat on a company jet far below what an equivalent charter flight would actually cost. That's the extreme edge of how skewed the incentive can get. The same way one tiny airport can cost taxpayers hundreds of dollars per passenger and still stay open. But tax code alone doesn't explain why executives keep choosing to fly private instead of just taking a commercial upgrade. The US built its commercial network around hub and spoke connections after deregulation, which means a direct trip between two mid-sized cities often means a layover, a terminal change, and half a day lost. America also has more than 5,000 airports available to private aircraft, compared to roughly 500 with scheduled airline service. A private jet can land at the small regional strip nearest the actual meeting, skip the security line entirely, and put an executive back at their desk the same afternoon. Texas alone has more registered private jets than any other state, with Houston and Dallas each hosting well over 300 aircraft. For a company billing that person's time at a few $1,000s an hour, the math works before the tax break even enters the conversation. And this isn't only a story about corporate boardrooms. Air ambulance operators use light jets to move critical patients between rural hospitals and major trauma centers. Often, the only fast option across states where the nearest specialist is hours away by road. Agricultural companies in Texas and the Midwest keep small aircraft on hand to move ownership and equipment between distant properties during planting and harvest windows. Disaster response teams have used business aircraft to move personnel and supplies into regions where commercial service was suspended entirely. Business aviation as a whole supports over 1 million jobs in the US and generates well over $200 billion a year in economic activity, according to industry figures. The same infrastructure that lets a hedge fund manager skip a layover also keeps rural America connected in ways commercial airlines gave up on decades ago. The average private jet owner has a net worth north of $1.5 billion, according to WealthX research, and that number is real. But it sits alongside thousands of smaller operators, family businesses, regional manufacturers, medical transport companies, who bought into the same tax incentive for entirely unglamorous reasons. Florida and California round out the top 3 states by fleet size, driven by a mix of finance, real estate, and entertainment industries that all move people across the country on tight schedules. The policy wasn't designed with any of them specifically in mind. It was designed to encourage equipment investment in general, and aircraft simply happened to qualify. None of this was one single decision either. A 1981 tax law made equipment depreciation faster. 2 national emergencies turned that mechanism into economic stimulus. A 2017 law made the deduction total and immediate. A 2025 law made it permanent. Deregulation broke apart the commercial network into hubs that make direct travel slow. And a country built at a scale where flying private can save an entire business day did what it always does when an incentive lines up with a real logistical need. It kept buying jets, year after year, until one country ended up owning more of them than everywhere else on Earth combined.